very warm welcome to Samvat Ideas, and the festivities have kicked off and clearly making it the right time for you to make the right investments that will give you great benefits. I'm Kamiya Verma.
Hi everyone, I'm Avanne Dubash and wishing all of our viewers a very happy Diwali. Let's get straight to it then and bring on board our experts who will be guiding us over the next 30 minutes. Joining in on the show, we have Saurabh Mukherjea, CEO, Institutional Equities at Ambit Capital, as well as Vikas Khemani, CEO, Edelweiss Securities. Now, I want to talk a little bit about the overall market setup where we were last year. There were so many hopes being pinned on the government, the policy action that was likely to be taken, and a lot has transpired over the last 1 year. Saurabh, as we step into Samvat 2072, what should be the expectation from the markets, and do you think that the government has delivered?
I think the best way to look at it is we're going into the new year with more moderated expectations, but I think that's a good thing. We don't have unrealistic expectations. I don't think too many investors out there are expecting the government to deliver firecrackers on the reform front. Similarly, on the global situation, with China and USA, the two big economies in the world going in opposite directions, there's a reasonably high amount of volatility there. So in terms of expectations for the year ahead, they're muted, and that's always a good thing. It's always a good thing to go into a market where expectations are muted. In that context, I think the way investors need to look at this year is it's going to be very stock specific. High quality companies, well-run companies, good balance sheets are going to be the way to go forward in the new year.
Okay, so stock-specific action then. Let's kickstart by getting you all the trading ideas that our experts have on their radar. And starting off with Vikas Khemani's portfolio up first. And Vikas, you like HDFC Bank particularly. Last 1 year, the stock has seen a good run-up, and you do expect some good things for the bank. Tell us, what are the fundamentals that you really like about HDFC Bank? And is this the only stock that you like in the banking space?
I think HDFC Bank has been all-time favorite. If you look at it, it's one of the best managed bank over the last 10 years, 15 years, whatever time frame you want to take. And I think in terms of shareholder value, it has delivered is phenomenal. And as we see, I mean, in the last 4 or 5 years, they have invested a lot in terms of building business, the new branch network in the rural areas, smaller areas. And I think the balance sheet is very sound and solid. So as I think we see economic recovery come in, they will grow, in my opinion, much faster than the industry, and that will be leading to better operating leverage, better ROEs. In my opinion, I think every Indian should have a lot of exposure towards HDFC Bank. If the FI limit was not there in this stock, according to me, stock would be 50-60% higher than where it is, and that is where I think maybe opportunity for domestic investors. You don't have many stocks in this of this quality character in Indian markets, and these are, according to me, stocks with possible equity returns and with sort of fixed income kind of risk profile, and those kind of risk reward profiles you look for it. And phenomenal leadership, phenomenal brand. I think it would be one of the best brand in the country. So I don't see, if you were to look at 5 year out, 20% plus and more likely closer to 25% kind of earnings growth is visible without too many sort of risks. And if that happens, you will see that kind of return being replicated in the marketplace. So that's the reason I think it's a clear compounding story in my mind.
Okay, so a safe private sector bank. It's been good in terms of fundamentals, management as well, and this stock has the potential to go even higher. So that's the first cracker stock, Vikas. But Saurabh, let's get crackling with your idea first. And an interesting mid-cap name that I'd like to discuss, PIINDUSTRIES. And despite adverse market conditions, this one has managed to maintain its market share. Do you think that given the competition in the sector, given the way things have been shaping up on the economy, that there is more potential here?
So PI is an interesting blend of export revenues and domestic dominance. So 60% of the revenues come from exporting specialty chemicals to global majors such as Bayer Crop Sciences, Dow Chemicals, Syngenta, etc. And what they're doing here is making specific molecules, 18 of them, on long-term contracts for the global majors. So high revenue visibility, strongly moated franchise, high ROCs. The domestic 40%, the 40% of revenues that come on the domestic agrochem front, that's been PI's traditional business. They're the market leader here. They're bigger than Rallis, they're bigger than Bayer in the Indian market on this front. And I don't see a domestic challenge as well. So you've got a business here which has moved from, I think, 18% return on capital employed 5 years ago to around 27% now. Earnings have compounded at around 35% for the last 4-5 years. Cash flow to EBITDA, good 100%, good cash conversion. So strong business, high revenue visibility, and as you rightly alluded to, in these uncertain times where neither policy nor economy is firing properly, a high-class stock like this available at something like 23 times forward, I think is a good place to invest with reasonably high expectations of capital gains over a 12 to 24 month horizon.
Right, and sort of clearly the focus on Farmer Connect, that has really helped in expansion as well for PI Industries.
So I think what's very interesting and in a way unfortunate for India is that our pharma companies are coming under clearly increasing FTA scrutiny. But if an Indian company is supplying into a Western chemical or a Western pharma major, that company seems far more secure. So PI plays that theme, and in a way the Indian pharma regulatory risk is not something a PI carries with it.
Okay, Vikas, then let's discuss your next cracker stock idea, and it's LIC Housing Finance. So why should one invest in this stock?
Very clearly, I think India has a lot of latent demand for housing finance and housing and as we've seen even in last 4 or 5 years it has not slowed down, and as the per capita increases over next sort of 10 years, you will see people investing, buying houses, investing into them and taking leverage. So this is one industry I do believe that in the credit side has one of the best risk reward profile, also has a huge amount of growth going forward. So you will see most of the housing finance companies can create 20 to 25% kind of credit growth, and scale is not a problem in this business. So, and as far as the LIC is concerned, it has a great parentage which allows you to get a better liability side, get control on the cost of borrowing, and on the other side I think there's an inherent sort of belief in the minds of borrowers being a good quality lender. So I think they will be able to maintain growth as well as the profitability margin, and that is what you are looking at. So this is another stock I do believe that without too much of risks on the credit side can compound at 20 to 25% over next 5-7 years, and that's the one reason. It is actually a bit boring though that there are not too many setbacks, and you have consistent growth and all. But I think
better to play safe than sorry, right?
Absolutely, and 20% return is not a small return. I mean, it's compounding is and most of the housing finance companies you would have seen have compounded because the balance sheet size and with the scale. So you have compounding and you can sort of create a big scale over long period of time, and I think it falls into that bucket very well.
Saurabh, wanted to get in your views on the same topic really in terms of the outlook for the banking sector as well. Maybe we're sticking to some of the stocks that have delivered consistently, but would you take a risk and say that maybe there is potential even in some of the untapped mid-cap PSU banking names? Just a sector outlook as to how you would look at that space.
So my reckoning is the heavy weight that banks have in the Nifty, something like 33-34% weight, I think that will come under pressure in the next few years. And the reason I say that is if we look at the weightage of banks in Nifty, it's heavily driven by the big private sector banks, who've got healthy ROEs, heavy price to book multiples. My reckoning is that the RBI governor's 23 bank licenses with a clear promise from him of more to come, will pressurize the profitability of incumbents. It will pressurize the net interest margins. I think it will potentially pressurize their fee income streams as well. It'll take a little bit of time for that to come through, but it's reasonably clear that at least half a dozen of these new banks will go public over the next 12 months or so. And as they raise money, and as brokers and investment banks spread the word that the new investment banks are on the offensive, I think the incumbent big private sector banks will face a profitability squeeze. So whilst I think the PSU banks' NPA troubles are well known and factored into their share prices, and I'm not as worried about that as I was a year ago, my bigger concern now is how Raghuram Rajan's very clear point of view that we need to have a more competitive banking sector will affect the profitability of the big private sector banks.
Okay, let's get to some other Samvat ideas and cracker stocks to watch out for. And you're talking about the FMCG sector, Saurabh. MARICO is a stock that you've picked out. And I just want to talk about why this one stands out, because in terms of rural demand, that's been a concern for the sector as a whole. Volume growth hasn't been that promising. Now, some would argue with the way the entire macroeconomic setup is, that the fact that the company is even delivering a decent volume growth should be satisfactory enough. But going forward, given once again the overall macroeconomic setup, the way things are, the company has managed to deliver in terms of numbers. Does this continue?
So I think the way to look at FMCG, I would say let's do a two-step process. Firstly, as you rightly said, rural demand has been under the hammer for a variety of reasons, including a fairly brutal cutback in subsidies in the February 2015 budget. My reckoning is through the direct benefit transfer route, this government will now start upping the subsidy transfers. The coming budget will be the first of it, and clearly as we approach 2019, direct benefit transfers will be ramped up quite aggressively by the NDA government. The verdict in Bihar, if anything, will push them in that direction. Now, given that subsidies will start getting up through the DBT route, which is the best FMCG stock to play, our reckoning is amongst the domestic FMCG companies, this is the best managed of the lot. The smartest management team, the best capital allocation, focus on two powerhouse products which have delivered for them for the best part of 20 years with an ability to innovate. And if you combine all of that, MARICO's management strength, sensible capital allocation, strength in two clear verticals where they are almost unchallenged, I would say as a play on direct benefit transfer, as a play on the NDA gradually gearing up for 2019, I don't think there's too many other stocks out there. I think it's fallen around 10%, I think in the last 2 to 3 months, but at 23, 24 times forward earnings, a company with this sort of franchise, given my take on direct benefit transfer, I think it's worth having in your portfolio.
Okay, and a good time to enter into it given that it lost about 9 to 10. Okay, well, we've already discussed a lot of ideas, 4 ideas from each of our experts there, but let's now slip into a short break as we get you some more cracker stocks that you should be investing in this Diwali.
Thanks for staying on with us. Still tuned into Samvat Ideas. We're in conversation with Saurabh Mukherjea as well as Vikas Khemani, discussing some cracking stocks that you can look to bet on for Samvat 2072. And in fact, let's just get back to the discussion on the markets then, Vikas. From last Samvat to this, it's been a little bit disappointing for the equity markets. We've lost out something like 1.2%. What's the road ahead in terms of levels that you're mapping out on the index, given that all that's transpired on the political front globally, the earnings season?
I think last Diwali there were a lot of expectations. I think sort of most of them didn't pan out, and also there were some global issues around the Fed rate, and they cropped up during the year. So I think for all those issues, global issues, market is reasonably sensitized, and now I guess expectations are very toned down. But the economic recovery is around the corner. You will start seeing corporate earnings picking up. This year also a lot of all the commodities prices came down, which took toll on the corporate earnings profitability because of the inventory losses. So I think all those are behind. So your inventories are cleaned out. Your operating leverage is in place. Growth is about to pick up. So I do believe that from here to next summer, I think we will see at least 18 to 20% kind of return in Nifty. I won't be surprised if Nifty gets closer to 10,000 by next Diwali. And that would be the hope, at least I would say.
And you think we made too much of the Bihar elections and the markets really managed to, convincingly recover?
Absolutely. I think Bihar, while it is, as I said, I was on the show yesterday and I said that, it was one day issue. It was Delhi happened, Bihar happened. Central government, nothing changes from central government. I think they have 5 years, they will complete. Economic recovery is also around the corner. Business, just only because of cycle also, I think you will start seeing a recovery. We have 5 years of bad cycle. And this cyclicity has to end, and I think that itself will take care. One part is government, but even if you just look at the business cycle, you have to see uptick. And obviously on the top of it, government is a little bit more proactive, and they will probably post Bihar election become more proactive to push the growth. So I am quite positive.
Okay, let's then get started with the trading ideas and rather investment ideas. Saurabh, would like to get in your thoughts on the infra space, and your stock idea is from the infra space. Ever since the Modi government came into power, this sector has pretty much been in the limelight. Which stock do you like here?
So I think if you look at the government's infra spend, it's in 3 areas. It's in roads, it's in railways, and it's in transmission distribution. Now, unfortunately, in railways, there isn't that many listed stocks that one can play, especially with a long-term conservative investment perspective in mind. But in roads, it's a happier story. I think roads genuinely, with the government upping the number of road contracts, a genuinely successful EPC industry is panning out there. I think something like 4,000 kilometers of roads have been contracted, are going to get contracted out in the current fiscal. SADBHAV Engineering, I reckon, is the prime road contractor to play, and Interesting company. It gives you access to EPC. You're buying probably one of the better EPC contractors in the country, efficient on-time delivery of roads, quite rare in our country actually. And over and above that, SADBHAV Engineering also owns something like 70% of SADBHAV Infrastructure, which has 12 roads in the heart of India's industrial belt. Roads which are tollable, which are revenue positive, and which will spring into life, whose profitability will really spring into life as and when the economic recovery kicks in. So this combination of a efficient, proven EPC contractor, someone who's got a good long-term track record of building roads on time and hence will win more EPC contracts, combined with 12 roads in the heart of India's industrial belt, I think makes SADBHAV my favorite road company. It's sensibly priced. I think the infrastructure bit was IPO'd 6 or 7 weeks ago at a reasonably healthy valuation. There's enough money on the table there for the investor. And if you want to play roads over the next 2 to 3 years, where I think there's a reasonably high degree of certainty, the NDA will focus on road building. It will be a vote getter in 2019. And therefore, on a road building platform, I think SADBHAV is the prime play out there at the moment.
Fingers crossed, and looks like great minds think alike, because you've picked out a stock from that space as well, a pure play on the urban infra EPC, JKUMAR Infra, and we were chatting about this before. Perhaps one of the issues that we've been grappling with as a country is the overall infrastructure improvement. What more do you think needs to be done, and why JKUMAR Infra?
So I think definitely government has started spending a lot on urban infrastructure in particular, and urban infra is also one of the big themes. So whether it is on roads, metros, sanitation, drainage, all those things are, I think that there's big spend plan, railways 8.5 lakh crores and all those things. So our estimate is that over the next 5 years, government will drive a lot of spending on the infrastructure. JKUMAR is a one company, according to us, it's a pure play, it has no BOT assets and all those things. Even in the downturn over the last 5-7 years, where every EPC company struggled, they were growing 15 to 20% kind of range year on year. The balance sheet is very, very sound. Currently, as I speak, there's no debt on the balance sheet. Probably you will not find any other EPC company where there's no debt on the balance sheet. And their execution track record is very, very sound. They complete most of their contracts either on or before time. And I think that is what is needed in this country. You don't have many, companies who could take up contracts of large scale. And mind you, they have got contracts in the recent Mumbai Metro. They got 2 packets. The only other company which got 2 packets was L&T. So you are talking about that league. Yeah. A small company competing with and getting business in that league. And today the order book is almost 7-8x of the current revenue. So I think your business is assured. Only thing you need to do is the execution, which I think they are good at it. So according to me, this can this can create a serious wealth for. It has already done over the last 2 years, but I think it can from here on also. It can create serious wealth for investors. So we are very, very positive on the
phenomenal company. Returns in the last 1 year, 100% plus.
Yeah.
So more potential.
And most people were not looking at the company, to be very frank. 2 years ago, the institutional shareholding was 0 in this. Today, it is almost, I think, about more than 50%. So I think, that clearly shows that how people are. And today, there are not many players who could build. We have actually a lot to build, but you don't have people who could build with good balance sheets. So I think this falls right in that place.
Clearly, both our experts are betting big on the infra space, but let's also discuss the auto space. And Saurabh, would like to get in your thoughts on auto space in specific. And one stock that has done exceptionally well is Maruti Suzuki, 46% over the last 1 year, from last Samvat to this Samvat. What are your thoughts on Maruti Suzuki and the auto space in general?
I mean, look, clearly, one of the few indicators which started blinking positively after the May 2014 elections was the passenger vehicle sales. And thankfully, the PV sales numbers have held up consistently over the last 14 months. What's also clear is Maruti Suzuki has gained share in that context. So from that perspective, the rally in the stock makes a great deal of sense. We've had a buy on it throughout. We are sticking to our buy. Where I think it makes a little bit of sense is just be a little cautious about these PV numbers, because PV perked up very early after the general elections. It's held up nicely throughout, and I have a little bit of a concern as to if Uber and Ola throttle off on funding on India, what effect it will have on the PV sales numbers. Because my reckoning is at least a part of the jump in passenger vehicle sales over the last year is driven by this whole revolution in the taxi market, which has arrived thanks to the US funded and the foreign funded startups. So if that holds up, Maruti will hold up nicely. But the stock's done well, obviously market leader without any other equal in its space, and hence we are sticking to a buy, but worth being a little cautious given the strength of the demand in passenger vehicles over the last 12 months.
Okay, that's the view on the auto space, but an interesting sector that you both once again have bet on, and that's the textile space, so to speak. Why is Pantaloon Fashion a cracker stock in terms of, the measures that the company has undertaken, the results that they've delivered, and is there potential in this space as a whole, or you think that this is solely the stock that sticks out?
There's a bit of, I think, broad theme here at play. According to, in my opinion, over the next 5, 7 years, 10 years, there's a big change going to happen in apparels towards branded segment play. Anything, which is more branded, because in India, you don't have any homegrown large brand. And if you look at Pantaloon, and this I'm talking about after merger from the Madura garments, which comes from Aditya Birla Nuvo, which I think would happen soon. Now, you don't have many play of this size where there are a portfolio of 3 brands which are 1,000 crore plus, Louis Philippe and Manson. And I think, so as we see, this is a big trend that you will see, like in many parts of the world, with the per capita income, the spend on the textiles or garments or apparels would happen more towards branded side. And I think this company has done it very well, scaled up, and delivered significant ROC and ROEs. So we think that they are one of the best suited players to capture this trend and look at, if you look at in other parts of the world, like what happens, what is the valuation of Zara, or, there are many, players which create serious value, as they gain size. And I won't be surprised if this company can end up becoming, over 10 years, 1 lakh crore market cap kind of stuff, because, the potential is huge, market size is huge, and, consumption has to pick up. And so, you have base set up for you, and you can 20-25% growth compounding story could be easily there. So in my opinion, this could be a long-term story.
Not on the Forbes billionaire list, the owner of Zara, so there is seriously potential.
So potential. I'm saying Zara is one success story, but I think there are many more success stories. So branded apparels is a very big segment, and it happens as the prosperity comes, as the per capita income grows, and you would see, if you check around you, more youngsters, more people are wearing branded apparels rather than going to the tailor and getting stitched, and that trend is here to stay. That trend is here to stay for long term. So in my opinion, it's a consumption play. It's a branded play. So it has to do well, and it comes from a good business group which has done very well over the years.
Sure. And Saurabh, how would you compare that to Trent then? What is your rationale as far as Trent is concerned, given that they have tied up with a lot of international companies and the envisaged expansion plans for Tesco? Is that expected to bring the losses down?
Sure. So I think before we go into specifics of Trent, I think one aspect worth dwelling upon is the rental cost, or the retail cost, rental cost that most retailers in our country or cinema chains or restaurants face. My reckoning is retail rental costs will come off in our country. I've been fairly vocal about both real estate prices coming off, but one corollary of that is I think retail rental costs will come off. That I think will help retail profitability in general, regardless of whether we are discussing a Pantaloon or a Trent. Specifically focusing on Trent, the reason I zeroed in on that was this is the only listed women's wear retailer in our country. So along the similar lines of what Vikas is saying, what we are seeing in the last 3-4 years is clear rise in branded clothing for women. Believe it or not, there's only 2 or 3 organized chains of women's wear retailing in the country. I'm sure I'm preaching to the converted here, but amongst those and amongst the Fab Indias and the Trends, this is the only one that's listed. Now Trent has 3 businesses. They've basically shut down everything else that made losses. They're focusing on 3 businesses. West Side, right, which is their flagship retailing business. They're making, I think,
something we're familiar with.
There you go, 11 to 12%, 6 to 8 week fashion refresh cycle, quite unprecedented in women's wear retailing in our country. A 6 to 8 week fast fashion refresh cycle, and still 11 to 12% operating margins, 12% same store growth for I think a good 3 years running now. Secondly, Zara, as you mentioned, the 50-50 JV with Zara, which is now running at a staggering 19% operating margin. That's after paying 6% royalty to the Spaniards. I think Zara has got 15 or 16 stores at the moment. Clearly scope to ramp that up to 60, 70 over the next 6-7 years. The only bit of the business which makes a loss is the Tesco JV, the Star Tesco JV. Tesco has injected $120 million into Trent's balance sheet as part of its equity contribution. I think this JV will continue making losses for 2 to 3 years, but even with that factored in, Trent will have a 10x growth in PAT this year, something like a 50% growth in PAT next year. And to the extent that if over and above that rental costs come off, I think you're seeing the beginnings of a fairly clear trend here. $700 million market cap with scope for much more to come here.
Okay, so that's a call coming in from infrastructure to fashion to banking. We've discussed it all. Thank you so much, Vikas, as well as Saurabh, for joining in on Samvat Ideas and sharing with us all of your top recommendations. And to all of our viewers, hope you took note of those stocks and hope you have a sparkling Diwali. Thanks for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.